Hello and welcome. This is Ike Hoffman with Tactica Real Estate Solutions, and today we're going to underwrite a 40-unit multifamily value add deal. This is a two-part video series. This first video is going to focus on qualifying the project with only a few basic inputs. Basically, we want to ensure that it's worth sinking more of our precious time into doing a more thorough analysis later on. In part two, I'm going to cover organizing the deal data. So that's the rent roll, the P&L, the property tax intel, reviewing the rent comps. Then we're going to input all of that information into Tactica's value add model. We're going to make some underwriting assumptions and assess the project from there. This video series, I'll be featuring two different templates that Tactica offers site visitors. The first one, and the one I'm featuring in this video, is Tactica's back of the envelope template. It's linked below and you can download it if you need a tool to quickly assess multifamily investment opportunities. In video 2, I'll be featuring our paid value add model. I also have that linked below as well. If you've been enjoying these underwriting tutorials, I'd really appreciate it if you liked the video, subscribe to our channel, and allowed us to notify you when we're releasing new video content. Let's dive in. The sole purpose of Tactica's back of the envelope template is speed. We want to input a rough estimate of what our pro forma is going to look like without sinking a bunch of time into it. Let's begin in the pricing, debt, and equity section. We're reviewing the financials of a 40-unit property that has value add upside. The broker's pricing guidance is $5,250,000. The project is not distressed by any means, but it is in need of some cosmetic capital. We received an agency debt quote at 65% LTV, interest rate of 5.85%, 30-year amortization, a 1% loan cost, and then you can see some of the other metrics populate below. Now let's take a quick look at the rent roll. For now, I want to gather how much total square footage there is. So I'm just going to highlight column D, where all the unit square footage is stored, and you can see in the bottom the sum is 36,755, and I'll plug that in, 36,755 in the rentable square footage, and there are 40 units. And then we'll begin populating the operations section. So let's go back to the rent roll. At this juncture, I only care about what the average actual in-place rent is at the property, not the market rent in column E. I could care less about what they think they should be getting. I want to know what units are actually leasing for. So I'm going to highlight all the rents, all the occupied rents in column F, and there's only 3 vacants, and I can see that the average rent at the property is $1,226. I'll come back to the template and input that $1,226 is the average rent. The broker suggested that there could be an average rent premium of about $100. And then for capital, if we're going to get a $100 premium, we're going to need to put some money into the units. So let's label this as unit capital, and let's estimate that for 40 units, we'll spend $7,500 per unit, which equals $300,000. In the way we have our capital stack structured in this, using agency financing, use the investor would be required to bring this $300,000 into the project to fund these renovations. Let's continue filling out the operations section. So for ancillary income items, let's go look at the most recent P&L we have on file. The rental income is summarized in row 2, and then I want to just focus on laundry, garage, and fees and miscellaneous income. So what I am going to do is I'm going to take the annual amounts for ancillary income. I'm going to divide it by 12 months, and then divide it by 40 units, and I'll drag that down. So for garage, they're earning approximately $45 per unit, and then for laundry and fees and miscellaneous, that $14.89 plus $15.15, it's about $30. Let's go back to the template. Parking was $45 per unit per month. Other was $30, that was the laundry and miscellaneous, and then we'll run a 5% vacancy. Now let's go back to that P&L statement. I also went online and grabbed the most recent property tax intel for this property. So you can see there's a 2022 assessment published online and a 2023 payable. And then there was also the 2023 assessment, but the 2024 payable information is not yet published. So essentially we were able to to get 3 pieces of information from the county website. But really, we'll only need the 2022 assessment, the 2023 payable, as the future taxes are going to tie to the sales price. I'm just going to take this data here, copy it, and go back into our template, and I'll just paste it off to the right as values. Assessment today, payable today. And then I am going to set the reassessment as a percentage of price to 95%. In other words, if we were to purchase this property for $5.25 million, it would reassess at 95% of that, or just shy of $5 million. And then that pro forma tax amount, taxes going up from $81,000 to nearly $84,000, will flow into the operations. Now, at this stage of the analysis, I don't want to get very granular with the operating expenses. I just want to run a rough expense ratio estimate to see how the numbers work at a very high level. So what I'm going to do, I'm going to call all expenses except property taxes. And I'll use Excel's Goal Seek analysis tool to back in to a 50% expense ratio. So I'll do Goal Seek. We're going to set our expense ratio to 50% by changing the per unit. And a per unit of 58.91 gets us to that 50% expense ratio. And then the final thing we need to do is enter in a historical cap rate assumption in the bottom right-hand corner. In this particular submarket, looking at B minus assets, a 5.5 cap rate has historically been where these assets are trading. So I'm going to put in a 5.5% here. And now we can do a quick review of how this deal pencils at a very high level. So one of the positives is that our pro forma cap rate, so our pro forma cap rate is the current rent today, adding that $100 premium, pretty much running ancillary income where the current property is on a 12-month basis, and then doing a 50% expense ratio. We're at a 6.08 cap, which is higher than the historical cap rate. So in theory, assuming we executed our business plan, we could take this property, stabilize it at nearly a 6.1% cap, and sell it back to the market at a 5.5 cap. That's a good thing. The yield on cost is also higher than the historical cap rate. So ideally, we would potentially see a larger delta between this 5.72 and 5.5. But the fact that there is a positive delta at all, it's a good sign, and it likely justifies doing a deeper look at this particular project. My initial perception of this deal is it's not a slam dunk by any means. It's not a no-brainer. But it does likely justify a more thorough analysis, and we should put it through the value add model, look at the P&L more in depth, scrutinize the rent roll, look at the rent comps, and try to see if there's any more upside opportunities we can shake out and potentially improve the metrics, improve the numbers, and see if it's worth making an offer. I like that the pro forma cap rate is higher than the market cap rate. The yield on cost is also higher than the market cap rate. So there are some initial signs that there is potential, but it's just going to require some more work and more time to really vet it and ensure that it's worth making an offer. If you've been enjoying these real estate underwriting tutorials, I'd really appreciate if you'd liked the video, subscribed, and allowed us to notify you when we're releasing new video content. Don't forget video 2 linked below. We're going to do a thorough underwriting analysis and Tactica's value add model. I'll see you there.